Welcome to the Riskwiser Zone. I'm your host, Louie. To kick off our show, let's take a look at two significant stories that are making headlines. Firstly, in a move that could potentially reshape the beverage industry, Coca-Cola has announced its plans to acquire a significant stake in a popular coffee chain. This strategic decision is expected to bolster Coca-Cola's presence in the competitive coffee market and provide a boost to its revenue streams. We'll be keeping a close eye on this development and exploring what it means for investors and consumers alike. Meanwhile, on Wall Street, stocks experienced a mixed day with the S&P 500 and Dow Jones Industrial Average ending on a cautious note. The Nasdaq, however, took a hit due to a decline in technology sector stocks. This downturn was partly attributed to concerns over U.S. President Donald Trump's proposed cap on credit card interest rates, which could have far-reaching implications for the financial sector. Bank stocks were also in the spotlight as Wells Fargo missed its fourth-quarter profit expectations, leading to a drop in its shares. Despite this, financial experts remain optimistic about the banking sector, citing that the current dip might be an opportunity for investors to buy into quality stocks at discounted prices. As we navigate these complex market dynamics, it's essential to stay informed and adapt to changing trends. Whether you're a seasoned investor or just starting out, understanding the intricacies of the stock market can help you make more informed decisions about your financial future. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and real estate today, exploring how inflation can impact mortgage rates and the housing market as a whole. To break it down, when we talk about inflation, we're referring to the rate at which prices for goods and services are rising. This can have a ripple effect on various aspects of the economy, including interest rates and, by extension, mortgage rates. The Consumer Price Index, or CPI, is one of the key indicators used to measure inflation. It looks at the average change in prices of a basket of goods and services that households typically purchase. Recently, the December CPI report showed that inflation remains higher than policymakers would like, with specific price increases in areas such as food, particularly beef. This kind of information is crucial because it influences the Federal Reserve's decisions on interest rates. When inflation rises, the Fed often responds by increasing the federal funds rate to slow down consumer spending and get inflation under control. This action, in turn, can lead to higher interest rates for consumers, including those looking to secure a mortgage. For potential homebuyers, this means facing not only potentially higher mortgage rates, but also higher home prices due to increased construction costs and other factors influenced by inflation. On the flip side, current homeowners might see an increase in their home's value, gaining more equity. However, for those in the market to buy, the prospect of waiting for possibly lower mortgage rates versus acting now is a complex decision that depends on individual financial situations and long-term goals. It's also worth noting that strategies like refinancing a home loan to consolidate debt can be affected by these economic conditions. Refinancing might offer a way to manage other debts, especially with options like cash-out refinancing, but it requires careful consideration of current interest rates and personal financial health. As we navigate the intricate relationship between inflation, mortgage rates, and the housing market, staying informed about economic forecasts and how they might impact future decisions is key. While predictions about future mortgage rates are inherently uncertain due to unforeseen events that can affect the economy, understanding the mechanisms at play can help individuals make more informed choices. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's dive into a fascinating story that's been making waves in the energy sector. Constellation Energy has been gaining attention for its ambitious nuclear expansion plans and strategic acquisitions, positioning itself as a leader in clean energy production. With its recent acquisition of Calpine, Constellation Energy is now the nation's largest and most diversified electricity producer. The company's strong focus on nuclear and geothermal power has earned it a reputation as a pioneer in the industry. Moreover, long-term deals with major clients like Meta provide robust demand visibility for Constellation Energy's clean energy strategy. However, it's essential to acknowledge that net income volatility due to fluctuating power costs remains a key risk for the company. Nevertheless, prudent hedging and power mix management could help mitigate this risk. As we consider the prospects of Constellation Energy, it's crucial to weigh both the opportunities and challenges. On one hand, the company's aggressive nuclear expansion and supportive U.S. policy provide powerful tailwinds. On the other hand, the energy sector is inherently complex, and unforeseen market shifts can impact even the most well-positioned companies. In conclusion, Constellation Energy's story serves as a reminder that investing in the energy sector requires careful analysis and a nuanced understanding of the risks and opportunities involved. As investors, it's essential to stay informed, adapt to changing market conditions, and maintain a balanced perspective. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.